Hello, my fellow investors, and welcome back to another earnings report video. Guys, let us take a look at today the company John Deere. We just covered this company on the live stream, so I'm just going to cover it right now for you guys on YouTube. Again, we are live streaming exclusively to Rumble for the next 30 days, 2 hours a day, 5 days a week. So if you guys would like to catch those live stream lives, make sure to check out the link in the description below for the Rumble channel. All right. Now, before we get started, guys, make sure to like, subscribe, comment. Really does help it with the algorithm on YouTube as well as Rumble. And also follow us on X. So with that said, let's jump now into the earnings for the company John Deere. So let's start off with the big elephant in the room. Deere shares slide on disappointing full year outlook. Deere's stock fell 3.8% in pre-market trading Thursday after the maker of farm machinery provided a disappointing outlook for the year. The company forecast net income of $7.5 billion to $7.75 billion for 2024 compared with the average estimate of $7.83 billion. Basically, they missed, or they're forecasting a miss based off of what Wall Street was actually thinking about that they were going to make. Looking at what he actually said, what the CEO said, we got, quote, moving forward, we expect fleet replenishment to moderate as agricultural fundamentals normalize from record levels in 2022 and 2023. Basically, he's basically saying, yeah, right now we're actually going back to normal, right? What we saw in 2022 and 2023 is not normal in the slightest. It's actually really abnormal. And right now, the reason why we're actually coming down when it comes to pretty much every metric is because of the fact that we're going back to a normal status. He goes on to say, regardless of where we are in the cycle, demand is accelerating for products and solutions that empower our customers to do more with less, and we are uniquely positioned to deliver unparalleled value to our customers. So right off the bat, guys, there you guys have it. Now, let's take a look at their GAAP EPS of $6.23. That was beat by $1.02. A revenue of $12.19 billion, which was a beat by $1.86 billion. All sounds great, except that this revenue is actually down 3.6% year over year. And net income attributable to Deere and Company for fiscal 2024 is forecasted to be in the range of $7.5 to $7.775 billion, which is what we saw before. So there you guys have it. There's the earnings summary. Now, jumping into the actual earnings, take a look at this. There's a little bit more data here that I would like to mention, and that is starting off right here. We got strong quarterly operating margins from equipment operations demonstrate structural improvement near mid-cycle volumes. Fleet replenishment moderating as agricultural fundamentals normalize, which is what I just said, right? Basically, they are coming back down to normal. And last bullet, full year net income now forecasted to be $7.5 billion to $7.75 billion. If we take a look at what the CEO said over here, what we just read was this part over here, not this part. He pretty much just says, Deere's first quarter performance underscores the effectiveness of our smart industrial operating model and the dedication of our workforce, enabling improved performance across economic cycles that surpass historical benchmarks. Moreover, we remain committed to empowering our customers to improve their productivity and sustainability through ongoing investments in the next generation of solutions, as evidenced by our partnership and satellite communications to expand rural connectivity announced this quarter. If we take a look at over here, the Deere and Company, we can see their net sales and revenues. Compare that to the first quarter of 2023 and the first quarter of 2024. Because yes, they are actually in the Q1 of 2024. They just reported their Q1. They end their year in like October. So that's why we're comparing first quarter and not year end, right? So when it comes to the net sales and revenues, we can see over here $12.65 billion in 2023 for the first quarter. And then for the first quarter of 2024, $12.2 billion, down 4%. Net income, you got $1.96 billion to now $1.75 billion. That's down a whopping 11%. And fully diluted EPS of $6.55 down to $6.23. So there's a lot more to this, guys. Of course, the link is in the description below for you guys to read for yourselves if you would like to do so, which if you do want to buy into this company, again, that's highly, highly encouraged. Now with that, let's head over into the calculator. We got the ticker for DE, market cap of $102.1 billion, a PE of 10.53. It's looking really good right off the bat when it comes to this PE. Current share price of $364.66. If we take a look at this on the 1 year, they are down 11.07%. Year to date, they're also down almost 9%. In fact, this 52-week range shows that we are near that 52-week low, 45 $345.55 to a high of exactly $450. So far as of the 15th of February, they actually fell intraday. They did have earnings pre-market and they fell intraday a whopping 5.23%, guys, $20.12. Coming back over here, they actually do pay out a dividend, my bad. So if we take a look at this dividend, they pay out $5.88 in annual payout. So if we put in over here $5.88, this will populate what we actually need when it comes to the numbers. Coming back, we can see that this is a yield of 1.53, so it's a really small yield. Payout ratio of 14.36, 5-year CAGR of 14.2, 3 years of consecutive dividend payments and growth. Ex-dividend date passed as of December 28th. Payout date was actually this month on the 8th of February, and they do pay their dividends quarterly. Taking a look back over here, we can see that based off the current shares outstanding, they pay out roughly $1.65 billion in dividends every year. And after we subtract this from the 5-year average free cash flow, they're left with $1.35 billion. As of the last year's free cash flow, it actually goes up. Look at that. It's really, really good to see. $2.5 billion. These payout ratios are looking perfect, actually. 40% for the last year's payout ratio and essentially 55% for the 5-year average. Looking really, really solid overall, guys. It's basically telling me that they can afford this dividend even if they wish to increase it as well. Taking a look at now the fundamentals, we already inputted some of these guys when it came to the live stream, so I just kept both of our grades here. Looking at the net income 5 years ago of $3.25 billion to 1 year ago of $10.2 billion, increase of 213%. The dip 4 years ago attributable to COVID, a little bit of a big jump from 2 to 1 year ago. That's why we both gave this an 85%. The free cash flow is very difficult to analyze. We got 5 years ago of negative $37 million to 1 year ago of $4.12 billion. That is an increase of 11,238%. Guys, I have no idea where this is going. Now, we had a discussion as to what caused this right here, right? And basically, we attribute it to the interest rate hikes. Now, we did have a comment on the live stream where one of the viewers, Ghostwalker, was saying that they're making a ton of acquisitions, they're investing into less people and more into more machinery, which is why, you know, they're paying a lot more cash, which is why their free cash is all over the place, which it is understandable. And I look at this and honestly, I'm like, okay, this is a 50%, right? Across the board, this is a 50% for both of us. Because, I mean, with an average of almost $3 billion, you got one in the negative, one coming down. Okay, fine, attributable to interest rates, but I just don't know where this is going, so we both gave this a 50%. The revenue, on the other hand, looks very nice. We got 5 years ago of $39 billion to 1 year ago of $61.2 billion. Guys, the one time where they went down was during COVID. Can't really blame them for that. They fell down by around, what, $4 billion or so. At the end of the day, this is an increase of 56.05%. That trend line hits those graphs almost every single time. I gave this a 95. Mike gave this a 90. When taking a look at the assets minus the liabilities, this looks really good. Consistently increasing, a little bit of a jump from 4 to 3 from what I like, but still really good. Average total assets being $91.5 billion, liabilities of $72.4 billion, a difference of $19.1 billion. Mike gave this thing 100. I gave this thing a 95. The cash flow minus the liabilities are very, very strange because you can see right here that, well, they were essentially coming down, right? If you just ignore the 5 year ago value where from 5 to 4 they slightly went up, the trend it is to go down. And if we take a look once again at their cash flow, we could see that even though they were doing fairly good when it came to the 4 and 3 year ago value, if you look at the 4 and the 3 right here, it is coming down, which is not something that you want to see. So they are packing on a lot of debt. Overall, though, as of 1 year ago, they're negative $78.1 billion, average being of negative $65.3 billion. Mike gave this thing a 20. I gave this thing a 10%. Shares outstanding, on the other hand, look really good. Pretty consistent buyback all across the board, all except for during COVID. Actually, I didn't even realize that they did issue, and in the live stream, we didn't even notice that because it's such a tiny amount. You guys can see over here on the 5 year going from 313.1 million shares to today of 280 million shares. That is a decrease of 10.6% on the 5 year and 0.6 buyback as well previous year to the current year. They did increase it from 5 to 4, as you guys can see, 313.1 to 313.7, but then they bought it back the following year It's a COVID increase. It was barely anything. Can't really blame them for that. Mike gave this thing a 95. I gave this thing a 90. And lastly, cash and equivalents. They currently hold $5.72 billion with an average of $5.3 billion. Overall grade for me was a 73 and Mike's was a 74. Basically, it's a company that just barely passes. The main issues that I have with this, it is the cash flow, honestly. And Mike also had the issue with the cash flow as well, where it was our lowest metric. Obviously, that translated into the cash flow minus the liabilities too. But if they get the cash flow straightened out, or at least give us an example as to where they're going, right? Because right now I have no idea where they're going. They're not giving us guidance as to where the line is going because it's all over the place. So if they fix the free cash flow, this will automatically be pretty close to 80% if I had to guess. So now taking a look at the discounted free cash flow, the first thing that we did is put in the projected share buyback. We went very, very conservative with this. We said, we don't think they're going to do another 10% in the next 5 years. Let's do something along the lines of like 3, 4, and 5%. And then for the revenue, if we take a look at Seeking Alpha, look at this guy. Seeking Alpha is saying that John Deere, best forward revenue, 0.97. So essentially 1%. We went with it. And well, we're just going to assume that they're going to lose revenue, right? We already saw this when it came to what we saw over here, right? We got revenue of $12.2 billion. That's down 3.6% year over year. So we're essentially just taking that into account, taking best case scenario, I guess you could say, -1, right? When it comes to revenue, 0, and then 1%. And with this, we get $204.07 to $223.75. And then adjusting for debt, they have a ton of debt, guys. They really do. $15.65 to $31.47. Margin of safety of 5, 10, and 15. $13.30 to $29.89. I look at this, guys, and it's very difficult. Usually when these things are that far apart, and there is no, I guess, direction when it comes to the cash flow. Red flags come up because I just do not know where they're going, right? Sure, at the current share price, 364, people might say they'll never fall down to 223. Well, it might, guys. It honestly might, especially if they continue to struggle. So this is my 2 cents on this, but Mike's 2 cents on this as well. So again, do with this information as you will, not financial advice. Calculator is available for free. And now looking at the dividend, their actual payout ratio in regards to the cash flow is looking pretty good, putting in $5,725. This nets you $92.32 in annual dividends. So John Deere, honestly, I'm not fully sure. Because, well, to be fair, I don't know the industry that well. Let's just take that off the table. But mainly, it's just I don't know where they're going. I get that it's a very niche kind of industry. You know, this goes beyond just a simple, family garden, right? This goes into like industrial thing. So I'm not fully certain, right? I'm not fully certain where they could actually go. So I would just, for me, this is more of just sit and wait to see what in the world happens in the next few years. This is my 2 cents on it. Tell me what you guys think about this company. Do you plan to buy it? Do you own it? And what do you think that they're going to do in the future? So with that said, guys, thank you so much for watching. Make sure to like, subscribe, comment. It really does help with the algorithm on YouTube as well as Rumble. Again, if you guys would like to catch our Rumble live stream, it'll be up at 7 p.m. Eastern Standard Time, 2 hours a day, 5 days a week. Since the week started Wednesday, we are going from Wednesday, Thursday, Friday. Not live streaming Saturday, Sunday, and then live streaming again 7 p.m. Eastern Standard, Monday and Tuesday, and then repeating back on Wednesday. Okay, guys? So that's essentially the schedule when it comes to this. And again, thank you so much for all the opportunities that you guys have given us on Rumble, as well as YouTube too, right? 3,000 of you guys isn't a small number. So thank you so much. And again, make sure to follow us on X as well. So with that said, peace out, and we'll see you all next time.